Oh, good afternoon, everybody. I make that 2 o'clock. Welcome. My name is Craig Hughes. I'm the head of tax here at Brown Butler. And I'd like to welcome you all to the latest seminar in our quarterly tax update for professionals series. I'm delighted to be joined today by the usual suspects of Vicky Hughes, Paul Clark, and James Hurst. And if there are any questions that we're unable to answer, don't worry about it. We will pick those up afterwards and get in touch with you directly. So, starting off, I'm going to spend the next 10 minutes or so just explaining the new extended loss carryback rules. So, as you're probably aware, these were introduced in the budget in March, legislated for in the 2021 Finance Act. Both companies and unincorporated businesses can take advantage of these rules. And in essence, what they do is they extend the loss carryback provisions from the usual 12-month period to 3 years. It applies to losses arising from 1st of April 2020 to 31st of March 2022. That's for companies. And for unincorporated businesses for losses in the tax years 2021 and 21-22. As you may expect, this is this is an extension of a tax relief. There are various conditions and restrictions which apply, and I'll talk through those shortly. And there's also a procedure for making the claims, and it's slightly different for companies and unincorporated businesses. And it does depend upon whether the claim is de minimis, i.e. less than £200,000. And again, later on, I will explain how that works. So starting off with companies. So the existing rules are that a trading loss can be set up against total profits of the same period and then carried back 12 months. There is an extension for 3 years where you have terminal loss relief. What the new rules do is that any trading losses arising in accounting periods ending between 1st of April 2020 and the 31st of March 2022 can be carried back and set up against total profits arising in the previous 3 years. And that's on a last in, first out basis, i.e. you set off against the most recent years first. There is a cap of £2 million on losses that can be carried back to the earlier 2-year period of the extended period. So the 1 year carryback, still no restriction on that. But when you're going back the further 2 years, the maximum you can carry back is £2 million. When you're looking at groups, they have a £2 million cap across the whole group. And the cap applies to each loss-making period ending between 1st of April 20 and the 31st of March 2022. So, by way of example, a company with a 30th of April year end, you'd have a £2 million cap for 30th of April 20 year end and a £2 million cap for losses arising in the 30th of April 2021. So let's look at an example which hopefully will bring the rules to life a bit more. Here we have a standalone company where we know that the cap applies. They have a current year trading loss of 3.5 million. However, in the previous 3 years, they had profits of 1.2 million, 1.6 in the 2 years back, and 1.2 million 3 years previously. So how do we use the losses? Well, we can carry back 1.2 million to the immediately preceding year, and that's uncapped. To the year preceding that, we can carry back 1.6 million to cover the total profits arising in that period. But in the period prior to that one, i.e. the period 3 years beforehand, we can only carry back a further £400,000 of profits, losses, because we've used 1.6 million in year 2, and therefore we've only got 400,000 left of the £2 million cap to carry back to year -3. And so then what we're left with are surplus losses of £300,000, which we would carry forward and use in the normal way. Moving on to unincorporated businesses. So again, existing rules, subject to certain restrictions, a trading loss of a tax year can be set up against general income for the loss-making year, the previous year, or both years. Again, there are some additional rules where you have losses arising within the first 4 years of trading and also terminal losses. With the new rules, losses in the tax years of 2021 and 2021-22 can be carried back and set off against profits of the same trade in the previous 3 years, again on a LIFO basis, so taking the most recent year first. So note that for unincorporated businesses, the losses being carried back under the extended loss provision rules can only be set off against trading profits in those earlier periods. And with unincorporated loss carrybacks, we need to think more about utilization of personal allowances and the dividend allowance and the savings allowance and how that interacts as well. So a few more things to think about there. Again, we have a cap of £2 million for losses carried back to the earlier 2 years of the extended period. Again, no cap on the 12-month carryback. And again, like the company relief, the cap applies to each loss-making period. Again, just going through an example to show how the relief works in practice. Here, looking at the last 4 years worth of results, we have profits in 17-18, 18-19, and 19-20, as well as some employment income. And in 2020-21, we have a big loss of £3 million, but we still have employment income of £50,000. So how would that work? So the £3 million, first of all, we'd set £50,000 against the general income of 2021, i.e. the employment income. We'd carry back 550 against the general income of 2019-20, so that's the trading profit and the employment income. That's your normal 12-month loss carry back under section 64. We then carry back 1.2 million against the trading profits only of 2018-19. Remember, for the extended loss carryback, it's only trading profits we can set off against. And then we set off 800,000 against the trading profits of 17-18, and that's capped. We're using 1.2 million of losses against 18-19, so we only have 800,000 left to use against 17-18. And then the £400,000 surplus we carry forward to be used in the usual way. The procedure for making claims differs between companies and unincorporated businesses. So for companies, we have to make the claim within 2 years of the end of the loss-making period. De minimis claims, so these are claims where the losses are £200,000 or lower, can be made outside of the corporation tax return once the period has ended and the loss is quantified. And that can be made through a form on the HMRC website. We've used that. It's quite a straightforward process to go through. The waiting time, of course, is waiting for the refund to come back. I'm sure we're all experiencing long lead times at the moment with HMRC processing loss carryback claims. For claims over £200,000, these have to be claimed on the CT 600 for the period of loss. Remember to tick box 45 of the CT 600 to show you're carrying back losses to a previous year, and also include a narrative on the tax computation explaining that you're making a loss carryback claim under the extended loss carryback provisions. Group claims are more complex. You need to appoint what's called a nominated company and submit a loss carryback allocation statement. A few more hoops to go through there in order to claim the loss relief for groups. But unincorporated businesses, a claim for 2020-21 has to be made before 31st of January 2023. A claim for 21-22 needs to be made before 31 Jan 2024. Claim is normally made in the tax return. However, a standalone claim may be made where the claim affects more than 1 year. And the standalone claim can be made as soon as the basis period for the loss has ended and the loss has been quantified. So you can accelerate the time at which you make the claim for those loss reliefs. Thank you for listening. I hope you found that helpful in terms of an overview of how the extended loss provisions work. And I'll now hand you over to Vicky.
Good afternoon, everyone. I think I know all of you. I'm the private client tax director at Brown Butler. So today I'm going to be cantering through some points on trusts. Hopefully they're things that you're all familiar with, but I just wanted to do a general overview and then focus at the end on some important changes to the trust registration service. So what are trusts? Very briefly, they're a way of managing assets for people. There are various different types of trust, and the type of trust dictates the tax treatment of them. The key parties involved in trusts are the settlor, being the person who creates and provides the assets into the trust, trustee or trustees, the people who manage the trust, and beneficiaries, the people who benefit from the trust. Usually you'd have a trustee that sort of dictates the rules that are applying to this particular trust. You can have them created by other written instruments, for example, wills, but just want to flag up that obviously drafting of trustees is a reserved legal activity, so accountants shouldn't be drawing any of those agreements up themselves. Obviously, everything needs to be done properly, so assets need to formally be put into the trust and the right paperwork done to do that. And in the tax legislation, you often hear settlements and trusts used interchangeably. Strictly, the term settlements is actually wider, but it doesn't really make any difference when we hear about these. So moving on to the next slide. Why do people use trusts? Well, they're complicated, but they can be very useful in the right circumstances. They can be very flexible and drafted to meet whatever the settlor wants, and it allows the settlor, as the person that's giving away those assets, to keep an element of control. Specific people can be included or excluded as beneficiaries. There's very few restrictions on the types of assets that can be held, and they can be held based in this country or overseas. There's various reasons, commercial reasons, family reasons, and also tax reasons why trusts might well be appropriate for your clients to have. They can be used to pass on assets while the individual's alive, so they're inter vivos trusts, or on death, which would be will trusts. They can also sometimes be created as part of court orders, so maybe on divorce. And if people have died without a will, sometimes the intestacy rules automatically ensure that assets are held on trust for beneficiaries. Typical examples that you see are in the wills of married couples, where the surviving spouse is provided for with a life interest, which is known as an immediate post-death interest. That allows the spouse exemption to be claimed. It allows the assets to be maintained for the survivor, but it protects them for the bloodline. So it stops the surviving spouse wasting those assets or frittering them away by meeting somebody else. And there can also be some benefits in terms of care home fees, but they can never be put in place just for that reason. So it allows an element of control and protection, can be very helpful in succession planning, can help where you've got younger individuals that aren't old enough to take responsibility for the assets themselves, and can provide for vulnerable individuals as well. So if we move on to think about the different types of trust, there are various different types of trusts. The ones that I'm going to discuss more are the three in the first column: interest in possession, discretionary, and bear trusts, and very much focusing on UK trusts. But in the middle there, it mentions various different other ones, which are hybrids of these ones that I'm talking about. And as a reminder, the UK tax treatment of trusts is dictated by the domicile of the settlor who's creating them, the residence of the trustees, the type of trust, and the assets being put into them. So I'll start to focus on interest in possession trusts, and they're often used to benefit adult children or grandchildren. They can be sometimes used for children under the age of 18. Beneficiaries entitled to the income for life or for a specified period of time, but the trustee dictates what they should receive. The trustee has to pass on all the trust income to the beneficiary as it arises during the tax year, less suitable expenses. They often have the power to appoint capital to the beneficiary out of the trust fund, but that's not necessarily the case. And on the death of the specified beneficiary, or when the defined period ends, the trust property might be held on trust for somebody else, or more commonly, a person named in the trust deed will become absolutely entitled to the trust property, and so the trust will cease to exist. As I've mentioned, they're often used in wills to provide for a surviving spouse for the rest of their life. And then when the surviving spouse dies, the assets pass outright to their children. And in doing that, you are allowing yourself to qualify for the spouse exemption and also for the residence nil rate band, which is very important. So on the next slide, just a reminder of the tax treatment of interest in possession trust from an income tax perspective. Dividends taxed at 7.5%, all other income 20%. Sometimes the income automatically just doesn't go to the trust, it actually goes directly to the beneficiary, in which case the trust return might not be required. If it's an interest in possession trust, which is also known as a life interest, then the beneficiaries can qualify for the dividend allowance. If the trust has paid the tax, the beneficiary as a basic rate taxpayer might not owe anything else, but they'd still need to do a self-assessment tax return showing that income with the credit attached to it that the trust had paid. If they're higher rate taxpayers, they would have some extra tax to pay. And sometimes you can get reclaimed positions for the beneficiaries, you know, where the dividend allowance applies to them, where there's savings interest and they can get some personal savings allowance, or potentially where the trade and property income, where they might qualify for the trading allowance or the property allowance. So moving on to discretionary trusts, these are trusts where no beneficiary has a right to any income or capital. The trustees here have a lot of decisions to make, and the beneficiaries only merely have a right to be considered as potential beneficiaries. So the trustees do have a lot of flexibility to decide when it's appropriate to give any of the beneficiaries anything and whether it should be income or capital or both. Usually we'd make sure that if it is a discretionary trust that we're looking at, that when they were set up, the settlor would leave a letter of wishes explaining how they might like things to be considered. Those letters can't be binding, because if they were, that would alter the nature of the trust, but they give guidance, and you'd hope that the trustees would take them into account, and they can be updated by the settlor as and when they want during their life. They're sometimes set up for, you know, if somebody wants to make a gift for the benefit of their children and grandchildren, but doesn't know exactly how that money will be needed for financial help in the future, or if the beneficiaries aren't capable or responsible enough to deal with the money themselves. So looking at the income tax treatment of discretionary trusts, they have a different tax rules. They do have their own standard rate band, which is £1,000 if the settlers only set up one trust in their lifetime. That gets reduced down for the, for the more trusts that the settlers set up, and the minimum amount that it ever is £200 per trust. Dividends are taxed at 7.5% within that standard rate band, other income at 20%. But then over and above that, dividend income is taxed at 38.1% and all other income at 45%. So they're they're the highest rates of tax that an individual would incur. The trustees don't qualify for the dividend allowance, and as a pure discretionary trust, neither would the beneficiary. But steps could be taken with discretionary trusts to do what's called a revocable life interest to improve that position, but that would need to be carefully considered on a year-on-year basis and additional paperwork done. All income received by the beneficiaries is treated with a 45% tax credit. So often there'll be some refunds to do for beneficiaries. The position is different where you've got settlor interested trusts, because that credit does apply, but it can't be claimed back. So then moving on to bare trusts. These are probably items that you're familiar with. They have trust in the name, but they're not actually trusts under the inheritance tax rules. There is a named trustee that essentially looks after the capital and income for a beneficiary, but and no other beneficiary can have any entitlement. But the income is taxed as if the beneficiary owned it outright themselves and not the trustees. So it would go just directly on the beneficiary's tax return. and the beneficiary is treated as owning the assets for CGT purposes. So they're a very good way of accessing the personal tax allowances of an individual. The assets form part of that beneficiary's estate for inheritance tax purposes. And looking at the position in England and Wales, when a beneficiary gets to 18, they can very much force the trustee to pass the assets over to them. There's nothing that the trustee can do. If the beneficiaries don't request them, then they can carry on being held on bare trust, but strictly when the beneficiary wants them, they have to have them. Usually they're used for minors, and they're common where a parent or grandparent is opening a bank account for one of their children or grandchildren under 18, and it ensures that the assets go directly to the intended beneficiary. So moving on here now to generally think about capital gains tax. So this is the rules for either interest in possession or discretionary trusts. You can get taxes payable when you put them into a trust, you sell them out of a trust, or a beneficiary gets some of the assets. There could be some release that apply. So principal private residence could apply, business asset disposal relief or holdover relief. And one of the key reasons that you would maybe consider doing a discretionary trust for clients is that you can hold over the gain in any of those assets to a pure discretionary trust. Trusts do have tax-free allowances. They're usually half that of an individual. If the settlor set up more trusts, then they reduce even further. If they're a trust for a vulnerable beneficiary, then they get a full usual CGT allowance. And the rates are 28% for residential property and 20% for all other assets. Now, coming on to the inheritance tax treatment of trusts, this is where it can get sort of more complicated and depends on the nature of the trust and when they were set up. As I've said, bare trusts, the assets are in the beneficiary's estate always, and provided that you survive the gift by 7 years, there'd be no inheritance tax to pay. With interest in possession trusts, where they're created during an individual's lifetime, if they were created before the 22nd of March 2006, they're usually no inheritance tax to pay during the life of those trusts, and instead they form a part of the beneficiary's estate on death. But any life trust of interest in possession created on or after the 22nd of March falls within the discretionary trust rules for inheritance tax, which are known as the relevant property rules, with 10 yearly and exit charges applying and limits on how much you can put in. If you inherit a qualifying life interest trust on death, there's the special rules that I mentioned before. Now, relevant property trusts, these are the discretionary trusts and interest in possession trusts created after the 22nd of March 2006. You have to bear in mind that there's a limit to how much you can put in without an inheritance tax charge immediately. That's based on the settlor's nil rate band. And if you exceed that, it would be 20% if the tax is paid by the trust and 25% by the settlor. You've got to factor in yearly and exit charges, but the assets don't form a part of the beneficiary's estate for inheritance tax purposes. So there's a lot to think about here, but trusts really can play a part in sensible overall inheritance tax planning for clients. So moving on now to think about the trust register. This is something that's been in existence since 2016-17. So hopefully you're all aware of it and have, if you've got clients with trusts, have made sure that they're on there already if those trusts have suffered taxes. Now, since 2016-17, this trust registration service has effectively replaced the Form 41G, where you notify the revenue of trusts, and all trusts which are taxable in terms of income tax, capital gains tax, inheritance tax, stamp duty, land tax, Scottish land and buildings tax, Welsh land transactions tax, and stamp duty reserve tax have to make sure they're on that register within a certain period during the tax year or after it. It's an important way that the trustees meet the anti-money laundering obligations as well. And the trustees, if at the moment, if there's taxes due on that trust, have to make sure that the details on that register are up to date each year. In April 2020, the trust registration service was amended to allow trustees and agents to update the trust register directly, because up until then, it was very clunky and any changes had to be written to the revenue about. There's a further expansion of the remit of this trust register following the 5th Money Laundering Directive. The rules actually came into play from October 2020, but the changes and the need to put them on this trust register are only, being formalised now. it was announced on the 1st of September, so just a few weeks ago, that the deadline for adding additional trusts is the 1st of September 2022, so less than a year away. So really, there is action that's needed where there's trusts, because very many more trusts are caught by this trust register, even ones that don't hold many assets and don't have an immediate tax charge. So it really is something for you to help your clients understand. So just to give a bit more information on the trust register then, the main changes are that all express trusts, so that's trusts that are created by the clear expressed wishes of the settlor rather than just the mere operation of law, have to register whether they have any tax liabilities or not, unless they qualify as an excluded trust. There are a few examples of trusts that are excluded trusts, but I think really it would be sensible for you to check what trusts your clients have, and then only after you know what they've got to consult that list to see if there's any exemptions. Some of the exemptions are trust imposed by court order, pension scheme trusts, insurance trusts, charitable trusts, will trusts, or trusts that only have an effect on death and for the first 2 years of their existence, some co-ownership trusts, some disabled trusts and personal injury trusts are excluded, but a whole swathe of additional trusts are now going to need to be put on that register. Trusts that are already on there now also have to provide some additional information, and some non-UK trusts will also have to go on there depending if they have a qualifying reason to do so that's mentioned on this slide. There will be penalties imposed if action isn't taken. They were lenient the first time round when this came, but I don't think anyone should expect, to delay it. The 1st of September 2022 should be recognised as a deadline to meet. It's now open to add these onto the trust register, and the deadlines for non-taxable trusts that were in existence on or after the 6th of October 2020 is by the 1st of September, as I've mentioned. Any non-taxable trust created after the 1st of September next year have to go on within 90 days, and changes to any of the trust details or circumstances should be amended on that trust register within 90 days of the change, not 90 days of the end of a tax year or anything. So I know that's a very quick canter through trust, but hopefully it's brought to your attention or reminded you of some of the key things. And I'll now pass you on to James to talk about that. Thank you.
Thank you, Vicky. And as Vicky said, I'm going to spend the next 10 minutes or so talking about some recent VAT changes and developments. I was looking at my slides earlier, as it says here, covering some recent VAT cases and some HMRC announcements in certain key areas that we see of interest to our clients. And the first one I'd picked out to start off with is around COVID-19 testing. And I was kind of reflecting earlier that actually after many, many months, it's important, I think, to all of us sometimes to kind of escape from talk of COVID and the pandemic and so on, and what could be more restorative and tranquil than having 10 minutes thinking about VAT. And yet my first topic here is going straight back into COVID-19 testing. So apologies for that, but it is it's very topical, and it's an area that affects not just suppliers of services, and it is a burgeoning industry, but also purchasers of testing services. And the key question's been whether the VAT is chargeable or not on such services. And it's been a muddle for a considerable time, really, because HMRC have been really reluctant to confirm the VAT treatment of certain supplies within this sector. And you can tell that it was a muddle when it really was hitting the newspapers with lots of articles and reports a few weeks ago to do with fit to fly tests and travel tests and so on. And after some considerable time, HMRC have actually now issued a brief which sets out their thinking on COVID testing. And what's behind some of it is actually some subtle shifts in the VAT rules. But the basic position seems to be, based on what HMRC have said, is that if COVID testing is provided as a part of medical care, and that means that the testing is carried out by a registered medical professional or is supervised by a medical professional, then it can be VAT exempt rather than subject to standard rate VAT. And a lot of the uncertainty had been around fit to fly type tests. Were these actually part of medical care, or was it something else, merely a kind of stamp in the passport to be able to get on the plane and travel? But HMRC have taken the view that if it's done by a medical professional who does the testing or supervises the testing, then it's VAT exempt. Conversely, if you get sent a test in the post and you do it yourself, then that appears to be taxable now. There's been a lot of difficulty with it within the amongst suppliers as to what the correct rule should be, and there's been a lot of inconsistency around this. And also there have been some subtle changes in the background to do with testing carried out at laboratories, where the laboratories charge people for the testing services. Previously, those were more clearly seen as VAT exempt, but actually HMRC have subtly changed the rules in the background and said that laboratories now are accredited rather than state regulated, and that can make their supplies taxable rather than VAT exempt. So if you are involved in that sort of area, it pays to check out whether you qualify for the medical exemption. The next bit I was looking at today was another measure that's come out of Brexit, which was looking at imports for and the VAT accounting of imports, and it's relevant to anyone who's importing goods into the UK. One of the changes that has accompanied Brexit is the postponed import VAT accounting, a simplification which means that rather than paying out VAT at the time of import, you can account for the import VAT and simultaneously recover it in most cases through your VAT return. It's much simpler to administer, much easier, less cash flow cost. You don't need bank guarantees and so on. So in my view, it's been a really successful development. Part of the problem over the last few months, 6 months maybe, has been a more practical one, in that HMRC systems are not really coping with all the new import entries. And they've got their old chief system running alongside a new system. And what's become very apparent is that a lot of taxpayers are not getting accurate monthly statements through. And so normally you need a monthly statement or a certificate that shows all your import entries for a month and the VAT thereon. And that's the amount of VAT that you're entitled to recover. But what we're finding is that there are a lot of errors on statements, monthly statements, with import entries not appearing, or other people's import entries appearing on your certificate. And also HMRC have issued incorrect certificates with a previous month's entries on them and things like that. It's been a real muddle. And what HMRC did only a couple of weeks ago is they updated their guidance, and they more clearly state in there that if you've got difficulty in reconciling your import entries, you can estimate the amounts and backfill it later. I would say it's really, really important for anyone who's importing at the moment to get it right at the moment and make sure that they do reconcile all their import entries. You can only recover the import VAT if you're the owner of the goods. And I think going forward, it's going to be a big area of HMRC focus, that they are going to come in the year ahead and look very carefully at import VAT and whether people have done it correctly. The first case I was going to mention today covers a point that is often a frustration I find of many clients. It's when HMRC are clearly unreasonable, that they've clearly acted badly, and it's whether you can make any of this in the courts to try and persuade the courts that actually the problem that's arisen, the VAT liability that's arisen, is at least in part the fault of HMRC not acting reasonably or acting incompetently and so on. But in practice, it's a really difficult point to pursue. And there are many cases over the years I've seen where taxpayers have said, clients have said, well, actually, HMRC should have seen this. They should have picked it up, but they didn't. And it's grown as an issue as a result. Or HMRC indicated that we should do it one way, and now they say it's something else, and we've got a VAT liability as a result. But it's really difficult to argue in the courts. And this case recently, the Zeman case, was about HMRC's powers and discretion. And actually, what the key point here for me is that where the law says that where HMRC may make an assessment is different to where the law says that HMRC must make an assessment. So where HMRC have got some discretion, the tribunal can actually consider whether that discretion was exercised properly. But otherwise, you have to just go back to what the law says. And even where HMRC may have acted unreasonably, that just may not cut any ice with the courts. The next case I was going to mention covers something different. But again, the point about HMRC's discretion does come into this. The case of Dollar Financial is a reminder, I think, that VAT is very transactional, and that often issues to do with deadlines and time limits can be really crucial, and something that in this case ostensibly was relatively straightforward. A company failing to register at the right time and looking to correct its registration date actually ended up in tribunal with £2 million at stake, and actually has, like, in a way, fallen into a bit of a legal black hole. And how did we get here? This particular case is a reminder of, I think, the importance of getting everything right when you register and making sure you've absolutely got the correct date right. In this particular case, it's to do with VAT grouping. And there was an existing VAT group with a number of companies in it. The taxpayer realized that one of the companies, Dollar Financial, needed to be registered for VAT. So they applied to put it into the VAT group. That was accepted by HMRC. It did need to be registered. Everything so far so good. But then it was discovered that the company should have been registered from an earlier date than the date it joined the VAT group. So they went to HMRC and said, can we backdate the date of registration, the date of joining the VAT group? And that's when the problem started, because HMRC have a discretion. They have a discretion to admit a company into a VAT group beyond the normal 30-day time limit. So normally you've got 30 days to notify HMRC. In effect, you can go back 30 days from any date to add a company to a VAT group. You can only go beyond that at HMRC's discretion, but HMRC never exercise that discretion, to my knowledge, only if HMRC are at fault. So this was a case where the company's already in the VAT group, but they knew that they needed to be registered earlier. And HMRC said, well, you'll have to be a standalone VAT registration. Well, that was going to create a £2 million liability on intercompany transactions. And so it went to tribunal, and the tribunal said, well, HMRC do have this discretion, but it's only a discretion about admitting a company into a VAT group and going back more than 30 days. Once the company's already gone into the VAT group, there's no powers there, as we can see, that allows HMRC to backdate that and move the date after the event, even if they wanted to. So the tribunal said that there's a legal vacuum and we've got no jurisdiction at all. So, as I said, a salutary lesson about making sure that the date is correct. The final case I was going to look at is another thought, really, I think in a post-Brexit context, about the VAT treatment in the financial services sector, and it's looking at back office services. So if you've got an insurance company or a bank or some financial institution and they outsource services to another provider, it's often very important that those services benefit from VAT exemption, because that reduces the VAT cost of that outsourced service coming back into the financial institution. And it's been a thorny area in the courts for many years. And the UK still heavily refers to the case law precedents within the European Court. And in this particular case, Target Group lost their appeal at the Court of Appeal. I think they've lost all the way through in the court. And their service was about moving money between accounts for their customer. And so what was this, did this benefit from a financial exemption, or was it, as the court said, an administration or debt collection service, and therefore was standard rated? I think the key point here is that actually the court seemed to be narrowing down the exemption for back office services to restrict it even more. And I think unless you are actually a bank or financial institution yourself, and you take on some commercial risk with the loan or the movement of the money itself, unless you have that, then it's really difficult now to get into the VAT exemption. And so I think this raises the point that since we still seem to be in the UK looking at European law precedent, the question is, post-Brexit, will the UK be considered changing the law to make it more beneficial for UK financial institutions now that we have a freedom not to follow European law precedent? My final slide is to focus on some HMRC draft guidance that's just come out a few weeks ago, which was looking at the question of compensation payments and whether these are VATable or not, and also at the same time looking at what's been a thorny issue around dilapidations payments in the property sector. HMRC issued a brief last September 2020, which said that they saw that pretty much all compensation payments as being VATable now, and that included or appeared to include dilapidations payments, which is where a tenant pays a landlord a compensation payment under the terms of the lease for putting the property back into the condition that they should have left it in. Now, going back 30 or 40 years, it's always been the case that dilapidations have been outside the scope of VAT. HMRC's brief in September 2021 threw the cat amongst the pigeons by suggesting it was now taxable. We still don't have HMRC's final word on this. It's been up in the air for pretty much exactly a year now. But what we have had, some of us have seen in the last couple of weeks, is some draft guidance from HMRC that appears to set out their thinking, which in the case of dilapidations is saying that these remain outside the scope of VAT in most cases. But other compensation payments, the mood music is definitely that these are now VATable, and they talk about, go back to all sorts of cases like the Moor Lane video case from the 1980s, where you get charged extra for being late returning your VHS video to the shop. That's actually an extra charge for rental and is taxable. So they go through all of this, but broadly speaking, most compensation or penalty type payments are now between a business and a consumer are going to be taxable. And just the final comment on this is that HMRC refer to parking charges and a decision that's awaited from the European Court about extra fees for overstaying your time in the parking bay. And what I found fascinating, again, in a post-Brexit world, is that HMRC is saying that they're awaiting further clarification from the European Court on this before making up their mind. So even now, they still seem to be looking back to Europe rather than to the UK courts to decide these things. And that concludes my section on VAT this afternoon.
Thank you, James. Good afternoon, everybody. In the final session of this webinar, I'm going to look at what used to be known purely and simply as tax investigations and inquiries by HMRC, but now increasingly they badge them as what they call compliance checks. And we saw at the outset of the lockdown 18 months ago that pretty much all existing inquiries were what HMRC referred to as being paused. As the months went by, they were gradually being reactivated and brought back into life, and indeed we have seen that. Coupled with now a focus on additional checks commencing. For example, in the previous webinar, you may recall that I covered the Taxpayer Protection Task Force that was commenced in March, which is now fully staffed with additional 1,200 HMRC officers, looking purely at the area of furlough and whether indeed there has been significant furlough fraud. HMRC are very suspicious that there has indeed been so, and that their attention is being increasingly within this area. So what are we now going to see? If a client in the cold light of day realizes, for whatever reason, maybe they have been finally pushed into a corner, but for some time they have been hiding something from HMRC and probably from you as the advisor as well. I have sat in a number of meetings over the years and one or two in the last few weeks where what a client or a potential client to us at that point, and the client to the existing advisor sitting in the meeting, gradually became more and more open-mouthed at what the client was disclosing. And the question then arises, is it to be something that has to be disclosed? The advice should be, the client, you must make a disclosure to HMRC of this irregularity. And whether it will be prompted or unprompted will be decided as to whether HMRC are already on the case in some form or another. And we've seen some of those. In other instances, HMRC may be completely aware at this point as to what the particular matter that the client needs to disclose indeed is. And how serious financially is this matter? Crucially within a disclosure is what has been the conduct of the client. Has this irregularity, which may have arisen over a number of years, been a result of deliberate behaviour? Almost certainly it will have in those circumstances. And thereby, what will HMRC's view of this be, particularly if HMRC come upon it before the client brings it to your attention as the advisor, so that you can advise that they should plainly make a disclosure? But what would happen if HMRC firstly became aware of the item? And how significant could the potential proceedings be? And from an advisor's perspective, what can you do? Well, this is where one of HMRC's codes of practice comes into play very handily. It isn't particularly well known, but the likelihood is that it will be increasingly made use of in the coming months. One of their codes of practice, or COP as HMRC call it, is Code of Practice 9. And what Code of Practice 9 relates to is basically where HMRC suspect tax fraud. So what can an advisor do to help a client through what could be quite a critical situation with HMRC, and to avoid, if at all possible, a criminal inquiry leading to a prosecution? Well, this is where what is known as the contractual disclosure facility comes in. And the contractual bit of this is very significant. There are a number of disclosure facilities that HMRC have put out there over the last few years in a number of regards, sector specific perhaps, but this one is broadly based and is to enable a client be they an individual, unincorporated business, or a corporate client, to make a disclosure to HMRC. But what is it and how is it conducted? The key to this is that it is an opportunity given by HMRC to a client to make a full disclosure of all tax irregularities. It's predicated on the basis that the main irregularity is deliberate, which is what Code of Practice 9 is all about. But it will include non-deliberate conduct by that client as well. In other words, it's a catch-all opportunity to make a full disclosure covering both deliberate and non-deliberate action. It is very much under a contractual arrangement. The client does sign documentation with HMRC to say that they will proceed with good faith and on a timely and open basis with HMRC and fully engage with HMRC. And in return, HMRC will not undertake a criminal investigation, but it has to be on the basis of a full disclosure. If a contractual disclosure facility is offered by HMRC, and they do look to offer this in as many instances as they possibly can, I cannot overemphasize that the client must make a full disclosure. It is not sufficient for a client to think, oh, well, I'll disclose X and Y, but I'll keep Z up my sleeve. That won't work in this. They must make a full disclosure of all the irregularities. There is a process to go through, and it can be quite a lengthy process. Several months normally is the case. It's carried out with HMRC's fraud investigation service by special officers, and it's now known as the COP9 unit within HMRC. But the whole point of it is, when you stand back from this, is to make actually HMRC's life quite easy, because it's all about settling on a monetary basis, a civil settlement. And thereby, once HMRC offer the opportunity to go through this facility, and the client formally says, yes, they will do so, HMRC gives 60 days to the client and the advisor to then produce what is called an outline disclosure, which is exactly what it says. It's a thumbnail sketch of what the irregularities are, how they were conducted, over what period of time, was anybody else involved, and a close approximation of how much tax and duties are involved. And that may be income tax, national insurance, VAT, corporation tax. I've even seen it include, as a consequence, higher income child benefit charge that the client wasn't aware that they needed to repay. So it is very much a catch-all. Otherwise, though, if a client does not sign to accept that they will take up the offer by HMRC to make a full disclosure and thereby come up with a monetary settlement, HMRC say formally that they will commence their own investigation, which may well result in criminal proceedings. HMRC don't really want to go down this route. They will do it if they have to, but it requires them to do a far greater amount of work. They would much prefer to sit back, receive the information from the client and the advisor, and to receive payments on account of the settlement, and to conclude the settlement in several months' time, with the vast majority of the work having been done on this side of the fence as opposed to on HMRC's side. There are indeed considerable advantages of the contractual disclosure facility, and it isn't that well known. This is why I wanted to highlight it at this stage, not least because of the furlough fraud initiative that HMRC are now starting. And indeed, in the last couple of weeks, I've seen in the professional and technical press commentaries that now that this taxpayer protection unit is fully staffed, they expect a number of cases to go through the COP9 process and the contractual disclosure facility. It's quite a formal process that is gone through, but it is readily manageable. And the advisor can indeed do that. The advisor takes the client by the hand and keeps a tight rein on them and makes sure that they're well protected. And HMRC are quite cooperative in that regard, so long as they can see that the advisor is absolutely on the case. And the key to this is that it is very much a monetary settlement, and it is not a criminal prosecution, so long as the client plays ball and makes a full disclosure. And they have to sign a certificate of full disclosure. So at the end of all this, if they have gone through this process, they've taken the opportunity to make a full disclosure, but they then don't make a full disclosure knowingly, and HMRC become aware of this, it then does become, in all likelihood, a criminal case. So the client, in my experience, is well advised to go through the contractual disclosure facility code of practice 9 route, and we are likely to see more and more of these in the coming months.
Thank you, Paul, and thank you, James and Vicky, for that. Very informative, as always. We do have a few minutes left to go through some questions. I have a couple. One for you, Vicky, and I think it's just something that was on one of the slides about third-party access to the trust register. What sort of what examples are there of this? And
Yes.
would this not put people connected with the trust at risk?
Yes, mentioned on one of the slides was that third parties can have some access to the trust register. Now that's predominantly thinking about organisations and people involved in anti-money laundering and counter-terrorist financing and associated offences. They can get some access to the trust, but HMRC have said that that will be very carefully monitored, and that information will only be released in certain limited circumstances. So there will be built-in safeguards, and over and above that, where individuals are vulnerable or minors, even more limited information will be given. And just as another point, trustees can use the trust register to share information they need with other parties that might need it for client take-on purposes. So solicitors or financial services firms, for example, you can extract information from the trust register, I understand it, that will sort of be, I don't know if it's a retracted version, but that can help confirm that the trust's on there, because that's a necessity for solicitors and financial services firms taking on trusts to know that they're up to date with their compliance requirements. So I hope that answers the question. And if there's any more, queries to that, just let me know.
Thank you, Vicky. One more for myself. Where can I find the form to make an extended loss carryback claim? Yeah, so this is the where you're making a de minimis claim, so where the loss is less than £200,000 for a company. You don't need to submit a CT 600 to make the claim. The form itself is on the Revenue website. The best way of finding it, and it's the way I always find it, is just type extended loss carryback into Google, and the first result will be the HMRC, link to the HMRC website page. And on that page, it goes through the rules around extended loss carrybacks, but then towards the end of that, there is a link to complete the form itself. And as I mentioned in the presentation, it's actually very straightforward. It's just a case of putting in details of the company, the loss that's being made, and the periods that it's being carried back to. So it's not too onerous to actually complete that. As I mentioned, the more onerous task is following up with HMRC on a regular basis thereafter, trying to get the money that you've claimed. That's more difficult than filling in the form itself. Now, I am conscious we're nearly at 3 o'clock. So for those questions we haven't been able to answer, we will get back to you separately. As I mentioned, the webinar is being recorded and will be on our website shortly after it finishes. Again, just like to thank you all for listening. I hope you found it useful. If you do have any questions at all, don't hesitate to contact any member of the Brown Butler team here. And we look forward to seeing you all again in about 3 months' time. Thank you very much.